Hi, and welcome to another episode of the Michael Yardney podcast. Now, regular listeners would know that I tend to have a guest on most shows, but every now and then, I just want to have a chat, just you and me, about an important topic. And that's what's going to happen today as we dive deep into an extraordinary topic that I believe touches the very core of our financial lives. We're going to talk about how irrational human behaviours drive property markets. Now, hold on a bit, because this is really very important in my mind. Now, I'm sure you've heard about booms and busts and bubbles and sudden market shifts. But what if I told you these weren't random occurrences? What if these market dynamics were the manifestation of our inherent psychological biases, our fears and our desires? What if the property markets weren't perfect, but they were rather complex living organisms driven by collective emotions of those who participate in it? People like you and me. Well, in this episode, I'm going to explore the fascinating interaction between psychology and economics. But more importantly, I'm actually going to show you how to take advantage of it. So while it's interesting, more importantly, you're going to finish off knowing how to take advantage of this new stage of the property cycle. We're going to unravel the mysteries of human emotions like fear and greed and overconfidence and wishful thinking. And I'm going to show you how these play out in the real estate markets, especially right now at this stage of the cycle. So buckle up, because I'm going to teach you how to take advantage of it all. So whether you're a seasoned investor, a curious homeowner, or somebody just interested in the human mind's influence on money matters, I really hope this episode is going to give you some insights and some practical wisdom. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Have you ever wondered what leads to the ups and downs of our property cycle? That's what I wanted to have a bit of a chat with you about today, because I think it's going to be very important to understand what's going on in investors' minds. I wanted to talk to you today about the journey through the property cycle that changes in investors' minds, but that drives our property cycles. Because when we delve into the realm of investment markets, we're not just navigating the sea of numbers and facts and data and houses, as I want to explain to you, a lot of it is largely driven by human psychology, especially on the investor side of the property markets. So, yes, those oscillating curves of booms and downturns that shape our financial landscape are not just driven by interest rates, inflation, consumer confidence, but they're deeply rooted in the human mind. Now, I want to explain a bit about this to you. Look, when I first started investing, I knew nothing about this, and that's why I want to help people understand what's going on. I knew nothing about economic fundamentals. I mean, there weren't podcasts, there wasn't the internet, there were actually very few books about property investing. So I did what a lot of people do today, and I bought close to where I live and close to where I went to school. I got it right. I was lucky, and I was also lucky with the timing of my purchase, but that isn't a luxury that people have got today. So I didn't understand anything about this. I didn't understand how our housing markets were driven by fear and greed of buyers and sellers. And as I studied economics and property markets and financial markets, somewhere along the line I learned about this theory of efficient market hypothesis. That was a darling theory of the past, which argued that financial markets were rational, and they perfectly reflected all the available information. However, it actually didn't take me long to realise that property markets were far from perfect markets, from rational markets. Look, as opposed to the share market, where all shares in the same company are sold at the same price, and in general, all players in the market have got very similar knowledge, the property market's far from perfect. It's what I'd call an imperfect market. It's in fact driven by fear and greed, and a whole lot of people making irrational decisions. They're making irrational decisions based on what they think a whole lot of other people are going to be doing and the decisions they think other people are going to make. Now, by the way, that's not a bad thing. It means I can use my knowledge and my contacts and my information, as well as my negotiating expertise, to my advantage. if I don't think emotionally and irrationally. But I'm going to explain a bit more about that in a moment. So let's just go back a bit and look at property cycles. Now, I know it's often said that property markets cycle every 7 to 8 years, but I remember seeing a great chart from commentator Michael Matusik that showed the ups and downs of the Australian property market, not the individual state markets, and he actually showed that on average, over the last 43 years, there was a market peak in Australia's property markets every 4 years or so. The last one was in March 2022, and then we know that the property market started to go down, when interest rates went up. The peak before that was September 2017, so that was about 4.5 years in that cycle. Before that, there was June 2014, so it was about 3 years between those two peaks. There was a longer period, September 10th to September to June 14th. But anyway, in one of my blogs, I've actually included this. If you look at Property Update, there's a great blog from Michael Matusik on this. But I guess the point I'm making, I can't show you a chart on the podcast, I'd love to, is that the markets go up and down. In general, the markets move up, but they're driven by a myriad of factors. And sure, they include interest rates and economic factors and government incentives and consumer sentiment. But several aspects of human psychology interacting help drive these phases of the cycle, including, as I want to explain to you today, individual lapses of logic and crowd psychology. You see, as individuals, we're not rational. Well, we're not rational when it comes to money and investing. Well, maybe apart from you and me, but most Aussies aren't. So there's been a number of studies, quite a lot. Psychologists have looked at behavioural finance, and they've shown that the mind of the individual investors is a fascinating labyrinth of emotions and cognitive biases. Now, I've spoken about cognitive biases in this podcast before, and there's a few great blogs on it on Property Update. By the way, if you don't subscribe to my daily Property Update newsletter, you should. Last year, we had 2.7 million unique readers. That's a huge part of the Australian adult population read Property Update. Anyway, as I was starting to say, there's articles about cognitive biases. Just do a search there. But they impact our investment decisions, and they become more pronounced at periods of market volatility or market change, like we've been experiencing recently, like at times when we experience all the mixed messages in the media. So let's just quickly look at a couple of these biases, see how they relate to you. Now, a big one's what we call confirmation bias. This is where investors seek information that confirms their existing beliefs. In other words, during a boom, this bias can lead to people overlooking warning signs because they want to believe that the market's going to keep going up. Of course, during downturns, people do the opposite. They ignore potential opportunities, as happened much of last year. But clients we helped last year and earlier this year at Metropole have done very well buying countercyclically. In other words, we tend to be most positive near the peak of the property cycle, when in fact we should be more cautious. And we tend to be more cautious near the bottom of the cycle, when most of the downside risks gone. So confirmation bias is the cognitive bias we have looking to confirm what we already believe. And that's unfortunately why so many investors get things wrong. Now, there's another bias that plays on our minds when we make investment decisions, and that's called recency bias. Now, recency bias, it means that you place undue importance on recent events. After a market downturn like we've experienced last year in 2022, people were fearful to invest because you tend to believe that what's happened recently is the way it's going to continue on. I guess it's much the same as following a boom. People were overly confident. Another bias is herd behaviour. In other words, as humans, we're inclined to follow the crowd. Now, there's science, I guess, behind this. It was safe in the old days to follow the crowd, not to go out on your own when you lived in caves or roamed the savannah. As humans, we're inclined to follow the crowd, especially when faced with uncertainty. Now, of course, this ends up leading to property booms when everyone's buying, and it accentuates downturns when people stay out of the market because other people are worried. Another bias, I guess, is emotional investing. Now, emotions play a crucial role in investment decisions, even though, as I said a moment ago, most of us think we're rational, but in general, our emotions overshadow irrational analysis. Now, when you're buying your home, when you're buying the place you want to live in, yes, it's important for your heart to sing as you drive down the street to look at it and your eyes to light up when you come home, and you're allowed to be emotional about that. But when we get involved in property investing, many of the investors I see are emotional. They're excited about it. They want to consider, well, could I live in that property? Of course, they shouldn't. And that's why it's useful to have a property strategist on your side, somebody independent, somebody to see your blind spots, somebody to make sure you stick to your plan. Oh, you do have a plan, a written plan, a strategic plan, don't you? Now, I'm just talking about some of the cognitive biases, the emotions, the way we think that affect our investment decisions. And fear and greed is another one of these. During a boom, greed drives investors to take on too much risk. And during a downturn, fear leads to being over-conservative with your investment decisions. And then there's the big one, the overreaction of markets. They tend to overreact to news and to events. So while the housing market isn't really as volatile in the short term as other financial markets, this overreaction is really much more clearly seen in the share market or the crypto market. But it does affect the housing market as well. However, investors who are aware of this tendency can sometimes capitalize on these irrational movements. And that's why, if you've been a regular listener to this podcast, late last year and early this year, I kept mentioning there was a window of opportunity. I kept saying that when interest rates eventually peak, it looks like they have, and when inflation peaks, and it definitely has, eventually others are going to come back into the market. The average Aussie is going to realize that now it's the right time. And so, therefore, I was suggesting don't overreact. In fact, counter-cyclically get involved in investment. Now, it's not too late. The market definitely has turned. The property market's bottomed at the beginning of this year. But still, people are nervous. People are concerned. There's so many worries going on in the world. There are so many worries going on locally that there still is enough people sitting on the sidelines waiting to hear how the market's going. And that's probably going to start happening next year when there's been a number of months of no interest rate rises and interest rates start to fall and the news is more and more positive. So yes, I still believe there's a window of opportunity, but not all markets are going to keep increasing. Not all properties are investment grade properties. So now, more than ever, correct property selection is important. So I've spent a couple of minutes talking about the various emotions, but over the cycle, emotions change as well. And there's lots of interesting charts that you may have seen, the up and down curvy chart of how emotions play out. Again, I'd love to be able to show this to you on the podcast. Look, I'm holding it up in front of you, but you can't see it. But let's quickly see if I can walk through the emotions, because as a new cycle begins, as we are now getting in the property cycle, optimism returns. People are starting to feel more positive. They believe there's going to be better returns. Property markets are going to go up. Rents are going to go up. Home buyers are considering getting into the market. And as the market starts to move up, we become more excited and thrilled at the gains we're making. And eventually, not yet, near the peak of the cycle, euphoria hits and we start to think, hey, we're really good at this investing stuff. And many people start to invest more and overcommit themselves. And each boom sets itself up for the next downturn, just like each downturn sets itself up for the next upturn. And as the market eventually turns down, people start to feel anxiety, denial, fear. They're worried, what's going to happen? What's going to happen to my property portfolio? They start doubting their investment abilities. So I'm talking about the cyclical nature of emotions of investors. And then as markets drop a bit further, as they did in 2022, some people get worried, some people get desperate, some people panic, some people sell up. And in property, if you can hold on to your property, you shouldn't be doing that. Of course, eventually the market picks up again. Hope returns and relief comes back. So I guess what I'm saying is that investors in general have a cyclical emotions over the couple of years of the property cycle. Now, obviously, one investor acting emotionally or irrationally isn't going to move the market. But when individual irrationalities come together, they actually don't cancel each other out, but they seem to magnify into a cacophony of collective behaviour. And I believe over the last couple of years, the cycles have become shorter, and the influence of mass media, social media, conformity pressures, they tend to drive the booms and drive the downturns, and the cycles happen quicker. I mean, the 24/7 news cycle accentuates irrational behaviour. It seems to have shortened property cycles. Now, the housing market is less liquid and therefore less volatile than shares or crypto, as I've said. So it's easier to see the crucial role of psychology in those markets, but it's also important to understand what's happening in our property markets. So look, let's look at this in a little bit more detail. Property markets have had significant growth over the last 4 or 5 decades. I mean, we know it's happened for even longer than that, but the Australian Bureau of Statistics figures go back to the 1980s, and it shows that over the long term, on average, properties have grown by about 7.5% per annum over the 40 years. Now, that's about 5% more than inflation. So property values outperform. But if you look at a chart of what's happened, there's long periods in every state where property values actually had periods of downturn, but also long periods of stagnation where property values didn't go up much at all. Really obvious in Perth since 2011 to 2021, maybe even a little bit longer than that, and then it started to pick up. I remember in Brisbane there was a really long period between 2011 and 2018 where property values didn't go up much. It's happened in all the states, and then what happens is the market picks up again and gets back to normal. Now, as I started to say a moment ago, there's lots of investor psychology behind this. There's definitely economic and local factors that drive these individual state property cycles. But during that, as I said a moment ago, the cognitive behaviours, the fear and greed are accentuated. So greed is important in our property cycle. It leads to investor speculation, and you've heard about FOMO, the fear of missing out, where when property prices rise and the news is full of people supposedly building significant property portfolios, making huge property windfalls. You know, you've read it, and I don't know, it doesn't really happen. You know, buying 10 properties in 10 years and retiring from your McDonald's job at the age of 30. But this leads to fear of missing out of potential gains, and it drives more people into the market. So again, we're talking about fear and greed. FOMO is part of that. And there's also, I guess, greed for the lure of tax incentives or other things as well. Hey, I'm going to try and invest for that. I'm not suggesting you should be doing any of this. I'm just explaining what drives property cycles. And similarly, there's fear, economic fears, fears of the economy, unemployment, inflation, interest rates, held back our markets last year, a fear of further market correction, and of course the media influence, as we said. So how do you overcome these? That's what I want to share with you as we finish off this chat, because if you now understand that the markets are not just driven by fundamentals, but they're also driven by human emotion, being aware of these can help you develop strategies to mitigate the impact, in fact, to take advantage of them. Okay, I think the first thing you need to do, and I hope I've tried to help you do that, is better understand the cycle of emotions, because the better prepared you are, the better you're going to be able to control your own emotions when things happen. That's why it's important to realise, as I said, that the market's not only driven by rational fundamentals, but by rational human behaviour. And then also go back and study the history of property cycles and realise that in the long term property values keep rising, but in the short term there are periods when property values fall. And as I said, every market has long periods of stagnation. Now, where do you get this information? Well, you can subscribe to my Property Update newsletter, but I'd also suggest you get the updated edition of How to Grow a Multi-Million-Dollar Property Portfolio in Your Spare Time. I first wrote that book way back in, I think it was 2006, and it's been on the shelf of almost every successful property investor in Australia. How to Grow a Multi-Million-Dollar Property Portfolio. You can Google it. You can get the Kindle version from Amazon, or I'll leave a link in the show notes and you can get a hard copy of it yourself. So learn about the property cycles. The next thing I'd recommend you do is take a long-term perspective. Adopting that is going to reduce your temptation to react impulsively to the short-term market movements. Remember, real estate's a long-term game. And by that, I mean you really should be thinking 20, 30 years. Short-term investing, in my mind, is 10 years. Medium-term is 15 to 20 years. And long-term, which is how you should consider real estate, is 20-plus years. Another way of taming your emotions is diversifying. Now, you can't easily diversify in property when you start off, but as you build your portfolio, if you've got properties in different markets, some in Sydney, some in Melbourne, some in Brisbane, they're all going to do well in the long term. But as I said a moment ago, they've all got their own cycles, and you'll find that if you've got some properties going up in value while others are not going up as much, it gives you a level of comfort because we are human. It'll reduce the emotional reaction to the market volatility. And another way of helping tame your emotions is to get professional guidance. First of all, having a strategic property plan. In other words, it'll tell you what to do and what not to do, and you're not going to get sidetracked by the emotions, but also having a proficient team around you. And I'm going to give you a shameless plug. I'd love my team at Metropole to help you, because engaging a financial professional can provide the objective viewpoint and help you navigate the emotional decisions. Now, a moment ago, I mentioned how the property markets are not a perfect market. I mentioned that economic theory, where a perfect market is one where all participants have got the same amount of information, the products are identical, and there's no barriers to entering or exiting the market. Yeah, the share market's not a perfect market, but it's getting much closer to it, isn't it? But clearly, residential real estate doesn't meet these criteria for a number of reasons. Well, first of all, the information isn't equal amongst everyone. Not all buyers, not all sellers, not all investors have the same level of information about property values, local market zoning laws. And even if they have access to this data, and boy, it's much more freely available now than it was, most don't have the perspective to analyse it properly, so they don't have the benefit of the information, the real benefit. The other is that not all products are the same. So unlike commodities, unlike shares, every residential property is unique. It's got different locations, designs, quality, appeal. Look, clearly some locations are going to outperform others. And clearly some properties are A-grade properties. Most aren't, of course. But as I was starting to say, different to shares, this is not a perfect market. Property is not a perfect market because even the orientation of the property, being situated on one side of the street, can make a property worth considerably more than the property on the other side of the street. Now, sometimes it's really obvious. I love giving the example of in Sydney, you may have a house on the north side of the street that's got magnificent views of the Sydney Harbour Bridge and the water, and then the house on the south side of the street's got magnificent views of the house on the north side of the street that's got views of the Sydney Harbour Bridge and the water. It's really obvious there why one property is worth more than others. But if you know your local markets, there's also smaller reasons why some streets are not as good as others, because maybe they're a bit of rat runs, a bit of a through road, why one side of the street may get more water or not as much light or not as good an orientation. So I guess the point I'm making is the property market is not an imperfect market, and most people don't know how to take advantage of this. And the other thing we talked about is that a perfect market is easy to enter and exit. You know, there's minimal costs in getting in and out of shares. But in property, it's much more difficult. You've got to get finance. It takes time. There's lots of barriers there. So again, it's not a perfect market, but you can use this to your advantage. The imperfections in real estate create opportunities for those with the skills, the knowledge, and the strategies to exploit them. Now, you're going to say, yeah, that's easy for you, Michael. You've been investing for 5 decades. What about me? Well, it may take years to accumulate this knowledge and the expert perspective. That's something you can't buy. But you could get the experts like my team at Metropole on your side, because we've got a number of distinct advantages in this imperfect market. Now, don't think me vain, but we've got superior knowledge. We've got extensive understanding of market dynamics, property valuations, regulations, the psychology of success that allows us to see risks, but also see the opportunities that others may overlook. Our team's been investing for many, many years. I've been investing for 5 decades. We've got a breadth of experienced, many of them. Our team are experienced selling agents. Our buyers agents are selling agents. Our property researchers have got a lot of knowledge. So, again, we're talking about how to use this to your advantage. Getting professionals like Metropole on your side will also help you with expert analysis. We've got insights from the frameworks I've fine-tuned over 5 decades, and our research gives us a deep understanding of local and national trends, and this enables us to predict movements more accurately to position your investments accordingly. Again, if we're talking about how to take advantage of the imperfect markets, having networks, having connections with other experts, other industry players provides invaluable insights and opportunities that aren't available to the average investor. So it's not fair. In the share market, it could be called insider trading. In property, it's networks and connections, and that's what the team at Metropole can provide. I guess we also have what I'd call emotional intelligence. We recognize how fear and greed drive market behavior, so we help our clients act rationally when many others would be swayed by emotions. We make sure you don't make 30-year investment decisions based on the last 30 minutes of news. And we've got bespoke strategies. We provide all our clients with individualized investment strategies. We provide a strategic property plan. So we're much more than just buyer's agents. We start off by putting a strategy together based on your needs, your risk profile, your timeframes, and your budgets. Clearly, this tailored approach is going to help you outperform the typical one-size-fits-all model. Hey, if you want to get my team at Metropole to help you, go to metropole.com.au, and we'd love to be on your side. But I hope that what we chatted about for the last, 25 minutes or so has helped you understand some of the factors driving the ups and downs of our property cycle. I was trying to show you that there's a dynamic interplay between human psychology and investment markets. And maybe this has just given you a bit of a window into the human mind as well as our financial systems. So I guess I was trying to get you that the core of all the complex investment decisions that we make are based not just on fundamentals, but by human hopes, fears, and dreams. We are humans. But I also hope that I showed you the imperfections in the residential real estate market are going to create opportunities for those with the skills, knowledge, and strategies to exploit them. And currently we're being given an opportunity to do that. This is the beginning of a new property cycle. This doesn't happen often. Now, I'm not suggesting you time the market, and I don't know your personal circumstances, but I'm hoping that by explaining this to you, you're not going to be too worried by all the negative news, and you're going to understand that what that does for others is going to give you an advantage in today's property market.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to share a lesson I learned from watching a movie. A couple of weeks ago, I watched an old American sporting movie, a baseball movie. It was called In a League of Their Own. And in one memorable scene, one of the team players, Dottie Hinson, tries to quit the team, telling her manager, who happened to be Tom Hanks, in the movie he played Jim Duggan, she said to him, "It's just too hard." Duggan replies, "It's supposed to be hard. If it wasn't hard, everyone would be doing it. The hard is what makes it great." Now that made me think, this is exactly the same thing with life, with your property investments, with your business. Don't let anyone tell you that being a successful property investor isn't hard. It is. Don't let anyone tell you that building a profitable business isn't hard. It is. Don't let anyone tell you developing financial freedom isn't hard, because it is. But on the other side of that challenge, on the other side of that difficulty, that's where the reward lives. And those that battle through the challenges get to reap the rewards. What kind of rewards? Well, look, there's too many to mention, but a few ones could be more choices in life, the ability to go to work because you want to, not because you have to, and of course the financial rewards that come with success, whatever that means for you. Whether it's knowing that you don't have to worry about money for your family, or the ability to make a significant contribution to charities of your choice, or even if it's just to buy yourself a nice present, a reward. All those rewards, though, aren't given. They're earned. And it is hard, but it's worth it. So the next time you want to quit when facing your first, your second, your 100th, your 50th, I don't know, 1,000th challenge, just remember what that rascal in the movie Jimmy Duggan said. It's supposed to be hard. If it wasn't hard, everyone would be doing it. The hard is what makes it great. So now go out there and be great, and don't worry about stumbling along the way. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?